All right, guys. So coming back to the idea of how FR is going to consist of different elements, the exams rather. So when it comes to the standards that are covered under this subject, we have 26 standards to be very, very specific. All right. So we have IS 1 that we look at. Okay. Then we have IAS 2 inventories, IAS 7 statement of cash flows, IAS 8 accounting policies change in accounting estimates and errors. Then IAS 10 events after reporting period, IAS 12 income taxes, IAS 16 property plant equipment, IAS 20 government grants and assistance, IAS 21 the foreign exchange rates, IAS 23 borrowing costs, IAS 28 associates and joint ventures, IAS 32 the financial instruments presentation, IAS 33 earnings per share, IAS 36 impairment of assets, IAS 37 provisions, contingent liabilities and contingent assets. Then we have intangible assets, IAS 38, IAS 40 investment property, IAS 41 agriculture, IFRS 3 business combinations, IFRS 5 non-current assets held for sale and discontinued operations. Then IFRS 7 and IFRS 9 is financial instruments. 7 is disclosure based, IFRS 9 is the main standard. Then IFRS 10 consolidated financial statements, IFRS 13 fair value measurement, IFRS 15 revenue from contracts with customers, and IFRS 16 leases. So these are standards covered. How many standards? 26 standards. So these 26 standards, by the end of next 15 days or 15th day, you all should have, you all should be walking, talking standard knowledgeable people. Okay, that's what you all need to focus on. Then, as I told you, there are IFRS summaries I've given. So how the IFRS summaries work is there's objective. Always when you look at a standard, look at it from the perspective of objective. What's the objective of a standard? Try to understand that first. Then the definition, what are different definitions that are available inside that standard. Then recognition, the criteria, the subsequent. Then the measurement. Then the presentation, how you present it in your financial statements and what are the disclosures required. What are the different calculation methods if available, and what are the elements that make up the cost where relevant. Okay. For example, if you take IAS 2 inventory, what's going to be the cost? PPE, what's going to be the cost, etc. Okay. So this covers all the standards of FR, which will be shared across in the LMS. I'll try to put it in the LMS. So let's see how I can share it across with you all. All right. Okay. And then Kaplan Power 20 is the number of questions that we have. 50 MCQ questions that we are going to focus on. So let's try to do at least 25 today. How to answer exam success skills, let's keep that for next class. So let's dive into the Kaplan Power 50. These are the questions I've selected, and they are standards that we're expecting to cover in the question. So today let's try to cover up to IFRS 9, which is until question 106. Okay. All right, so let me share the question screen. Let me move all the questions to the Excel. That would work better. Okay, when I'm moving it to Excel, it's cluttered. let's try to do it on the through the PDF. Because Excel is quite cluttered when I try to copy and paste all the questions on Excel. So Umar, there are 26 standards that we have. 26. We just looked at that. You might have watched a little bit of a recording. Right. Okay, guys. So let's start. Right. So there are 50 questions. As I told y'all, I've selected 50 Section A questions covering contents from different standards, right? Covers almost all the standards, the 50 questions, and they are all strong questions, right? Not very straightforward questions. Something that requires you to think on your feet. Okay? Right. So this is the question number 2. So it's in the order of Kaplan question order. The question number 2 of Kaplan says, on 1st of July 20x4, experimenter opened a chemical reprocessing plant. The plant was due to be active for 5 years until 30th June 20x9, when it would be decommissioned. At 1st of July 20x4, the costs of decommissioning the plant were estimated to be 4 million in 5 years' time. Experimenter considers a discount rate of 12% is appropriate for the calculation of present value, and the discount factor at 12% for 5 years is 0.567. What is the total charge of statement of profit or loss? Okay, they are asking the total charge for statement of profit or loss. So what are the charges out of this that you all think will go on the statement of profit or loss? What do you all think? Let's move the chair away. So in this question, what are the elements that we are going to look at in statement of profit or loss? One, it's going to be what happens when there is discount rate. There is a present value calculation, right? So when present value calculation happens, what happens? Unwinding of discount. Okay, so what they are saying is 4 million in 5 years time. So you have to, let's use Excel as well. Let's do a split view with Excel. Just do the working here. Okay. Okay. So when you look at this question, what are the important figures here? They are saying it's 4 million, right? 4 million in 5 years time. So you have to take the present value calculation. So they've given the discounting factor for 5 years, right? 50, what's the discounting factor? 0.567. So how do you arrive at the present value? 4 million into 0.567. So that is 2.268. Now that is going to be the value that you're going to capitalize in non-current asset, as well as you'll be raising a liability. Okay, a dismantling cost liability, a provision. Okay. Now what is going to be the unwinding cost here? What's the percentage? 12%, right? 12% is the effective interest rate. This into 0.12. 272.16. Is that all? It's finance cost. Is that all that you take? What else goes to your statement of profit and loss from this? When non-current asset is capitalized, depreciation comes in, right? So how is depreciation element going to be here? So what's going to be the depreciation? This is the cost that has been capitalized, right? How are you going to depreciate this? How many years? 5 years. This is your depreciation. Or let's do depreciation also under this itself. 2.268 divided by 5 years. That's your depreciation. So what's the total? 725760. Do we have that option here? Option B. Okay. Question 2. Option B. What's the standard that's being covered here? IAS 16. Right? Question is pertaining to IAS 16. As well as what's the other standard connection here? IAS provisions 37. Okay? Remember that. Then we have the third question. Third question says, an entity purchased property for 6 million on 1st of July 20x3. The land element of the purchase was $1 million. Okay, now here the dates are also very important. Question 3. Right? Property. What's the price of the property? 6 million. Out of this property, what are the two elements under this property? There is land element and building. Land, building. Right? So land element they are saying is 1 million, right? 1 million. So what would be the building element? 6 million is total property, land is 1 million, then building will be 5 million. Correct? So when was it? When was the purchase happened? 1st of July X3. Right? Where is the year end? 30th of June, full year. Okay, so they are asking for 30th of June 20x7. So what are they asking? Building. Now here, out of land and building, will land be depreciated? No, land is a non-depreciable asset. So what will be depreciated? Building. What is the useful life of building? 50 years. Residual value is nil. So depreciation on straight line method. Straight line method depreciation is going to be cost minus residual value divided by useful life. No residual value. Therefore, cost of 5 million divided by useful life of 50 years. That's going to be the depreciation. Okay. Then they are saying that on 30th June 20x5, how many years? 20x3, 20x4. 2 years. After end of the second year, they are revaluing to 7 million. Revaluation happens after 7 years, right? 1st of June X4, or let's say, okay. What we'll do is let's change the formatting a little bit to make it more clearer. Land, building, if I zoom the question, I have to zoom it out a little bit. That's okay, no? If Excel is zoomed out a little bit, is that okay? Works okay? Sure? Right. Right. Land, building, total. Right. This is the format that works best, right? 1 million building is 5 million, total is 6 million, right? This is as at 1st of June X3, right? Depreciation for the year. What's the depreciation? This divided by 50. So what is the carrying amount? Amount carried down, how much is that? This is going to be 1 million. No depreciation. Land is going to be this minus depreciation. So what is the total? Still revaluation not occurred. Okay, still we are revaluation happening in 20x5. So we first need to figure out what was the value when the revaluation happened. Yeah. Okay, so that's what I'm coming at. Okay, then there is another depreciation, right? Now this is our carrying amounts as at 31st of July X4. All right, right. Then depreciation of, again, straight line, same figure appears here. So what would be the carrying amount? Carrying amount as at X5. How much is that? This minus this, and this remains the same. Yeah. So what is the total cost? Total is 5.8. Now at this point, revaluation happens. Okay. Revalued amount. Right. So what are they saying? Total revaluation, it becomes 7 million, right? So out of that, what is the revaluation components? Property, 7 million. 1.24 is land, 5.76 is building. 1240 is land, 5760 is building. Okay. Now this is what the total is. Now that makes the total 7 million. Okay. On 30th June, meaning after 2 more years of revaluation. Okay. 2 more years of revaluation. What happened? The property was sold. Now we need to do the depreciation for the revalued amount. This is going to be depreciated over how many years? 50 years? No. 50 minus 2. 50 minus 2. 2 is already done. 120. So carrying amount as at 31st July X6, right, is going to be this minus this. This remains Same. Why it's not depreciating? Right, 6.8. Now there's going to be one more year of depreciation, right? Depreciation. Again, it's going to be remain the same, right? Same depreciation. That's going to be 120 divided by 48. 120. Carrying amount as at x7. How much is that? This minus this and this plus this. 6760. Right. How much is property sold for? Proceeds. How much? 6800. So what is going to be the gain? Do we have that option here? Option A. Right. Again, what's the reference? IA 16. Is that clear? Now, do you think doing this working is necessary in the exam, real exam? No. You can even do it without a working also. Now, why I'm doing this working? To show you all how this is done. But in an exam, you all need to know the shortcuts of doing it. Right? So in an exam, real exam, you do that. For example, you can, you just know the dates. Okay, 2 years, the initial depreciation, then 2 years revalue depreciation, then the disposal. So you should be able to do it in your heads. Okay? Is that clear? Clear? Right. Then the next question is question number 5. Now this is going to be pertaining to government grants, IAS 20. On 1st of January 2021, STI received $1 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years. Due to an economic downturn and reduced consumer demand on 1st of January 2022, within a year, STI no longer needed to employ any more staff and the conditions of the grant required full repayment. What should be recorded in the financial statements? Now the full repayments is required. Now here you have to evaluate what component was already recognized in the income and what remains unrecognized. Okay. Right. So that's the question number 5 of Kaplan, right? 4 years grant received 1 million. 1 million over 4 years. So how much is he going to release every year to the income? 250,000. So how much would he have released? 250,000 was released, right? What component was not released? 1 million minus this was not released. So what happens? This remains in under deferred income liability. So that you have to reverse, meaning you reduce the deferred income by 750. And then what do? You have to recognize now you have recognized an income of 250 now, so to reverse that, a loss of 250. Do we have that option here? Option B. Clear? Now this is what I was talking about when I spoke about IAS 20 in the planner, right? How the repayment works. Okay, so repayment, whatever has been recognized in statement of profit or loss needs to be not de-recognized, but if it was income that was recognized, you have to reverse that. Reversing that meaning what? Expense meaning what? Loss, right? You have to end up paying that.
Are we getting this loss or reduction in income?
Loss, because we've already recorded an income, right? So when we recorded, we've already taken it for profit. We've shown it as a profit. So this year, we know next year financial statement of profit or loss only, we are adjusting it.
So if it is occurring in same year, we are reducing.
Same year, you won't even record the income. If it happens the same year, even income will not be recorded. You see that from deferred income itself, you are going to eliminate. Okay, right. All right. The next question, question number 13. Right. Question number 13 says, what has happened here? Why is it blur? It's not. Oh. Okay, fine. Right. Okay, remember the fourth option is net income of 2 million, right? Fourth option is on next page, so let's remember that. Smiths & Co. purchased a new building with a 50-year life for 10 million on 1st of January 20x3. On 30th June 20x5, Smiths & Co. moved out of the building and rented it out to third parties on a short-term lease. Smiths & Co. uses the fair value model for investment properties. At 30th June 20x5, the fair value of the property was 11 million, and at 31st December 20x5, it was 11.5 million. Yes. So what happens here? IAS 16 to IAS 40. See, the questions also what I have selected are reflecting the tips of the study plan. Right? So when we do these questions, you all already have covered most of the study plan related clarification, and you all be able to clarify it better. Okay? Right. Now what happens here? What do you think happens here when IAS 16 is transferred to IAS 40? What happens? Now here also they are asking the impact on profit or loss. What are the impact that we're going to have? What did we look at? IAS 16. First, you have to revalue based on IAS 16. So there you'll be revaluing to 11 million, right? Right? 50 or 10 million, 50 year useful life on 1st of January 20x3. 20x5, after 2 years, you are changing the value. So whatever the difference of, between 11 million and the carrying amount was, will be recognized through other comprehensive income. Will that impact profit or loss? No. Why? IAS 16 revaluation surplus goes under other comprehensive income. So that has no impact on your profit or loss. Then 11 million becomes 11.5 million under fair value. Now it is IAS 40. So what's the gain here that goes to profit or loss? 500,000. Right. But apart from 500,000, is there something that impacts the profit or loss? Or is B correct? Depreciation. Only after it's classified as IAS 40, there is no depreciation. But before that, 6 months depreciation should be there, no? Right? It was in 6 months, right? 1st January on 30th June. Now, after 6 months, exactly they are changing. That 6 months worth depreciation also will be considered. So, what is going to be the depreciation? 10 million divided by 50. That's going to be 200,000. 200,000 into 6 months, 100,000. So 500,000 gain, 100,000 depreciation. So what's the net impact? Net income 400,000. Option A. Does that make sense, guys? Guys online, Azmat, Shenuri, Zainab, does that make sense? Or do you all want me to do the working for every question here?
Are those a couple of questions?
Right. Otherwise, if you want, I can even do the working here, but doing the working is not always helpful because doing the working might take some time that we can actually do through discussion. Okay?
So can you share the workings?
Sure. These workings, right? I'll share the entire question paper itself. Right? Okay. Now, 14th question says Gilbert took out a 7.5 million 10% loan on 1st of January 2086 to build a new warehouse. Okay. What is the standard borrowing cost? IAS 23. So we discussed IAS 16, we discussed IAS 20, we discussed IAS 40. Now we are discussing IAS 23. Right. What does borrowing cost say? You have to capitalize the borrowing cost only of the used during the period of construction. Okay. So in the year in the 30th, build a new warehouse during the year. Construction of the warehouse began on 1st of February 2086. When was the loan taken? On 1st of January. Construction began on 1st of February. Do you capitalize 1st of January for end of January? No. That is going to be expensed. Only from 1st of February you are going to capitalize that. And was completed on 30th November 2086. How many months did that take? Construction. Feb, March, April, May, June, July, August, September, October, November. 10 months. Right? As not all the funds were needed immediately, Gilbert invested 2 million in 4.5% bonds from 1st Jan to 1st of May. Now what happened? What happened now? Now there is a set off, right? To set off and to get benefited with again, what does Gilbert do? Invests. So what does borrowing cost say? You will be capitalizing the net within the construction period. Okay, now how does that work? Let's do that question. Let's do that work.
Capitalize 10 months interest.
Yeah.
Minus the
7,500 into what's the loan percentage? 10%. What's the interest? 750. That's for 12 months, right?
yes.
That's for 12 months. This into 10 divided by 12. How much is that? 625. Now coming to the investment. What is the investment? 2 million, right? Not 2 million into 4.5%. This for how many months do you need to take under capitalization? This 1st Jan to 1st May, meaning Jan, Feb, March, April, May month is considered or not? No, they've confused you here. They could have even given you April, end of April, but they gave you 1st May. Why? To confuse you so that you forget to look at the date, you look at the month and you take more months. No? That's what examiners do. So be very careful when you're reading the question. Jan, Feb, March, April. 4 months was what the investment was about. But out of the 4 months, only 3 months was relevant to us during the construction period. This into 3 divided by 12. So this minus this. What's the answer? Do we have that option here? So here you have to write the answer, which is going to be 602, 500.
So I didn't see how did you do
90 was 2 million. Now it's yeah, only for phone. No, 2 million for 4.5% annual, right? So if you take for 4 months, we can't take 3 months here. No? Right now, out of this, 1 month you're going to expense and 1 month you're going to recognize as income.
So 4.5% for the 1 year.
1 year, no. Always when they give interest rates, remember that's for a year. So when you take that interest rate and you do the calculation for a year, then you do the period allocation. Okay, that's very important. Clear? Is that clear? Right. Otherwise, now out of this, if they had asked you what is going to be the income and expense, that's non-capitalization portion, then you know that 1 month of this into 1 over 12, this needs to be expense and into 1 over 12, this needs to be recognized as income. Make sense? Yeah? Sure. All right. So what's the answer? 602, 500. Right. Then we move to the next question. So we're done with IAS 23 as well. Question number 19. AMCO carries out research and development in the 30th June 20x5. Now comes IAS 38. AMCO incurred total costs in relation to Project X of 750,000, spending the same amount each month up to 30th April 20x5 when the project was completed. So what's the total cost? Let's do the working here. 19. What's the total cost? 7. In the year end 30th June, AMCO incurred total cost in relation to Project X of 750,000, spending the same amount each month up to 30th April. Right, in the year up to 30th April. So when did the year start? July. July, August, September, October, November, December, January, February, March, April. 10 months. Okay. So this 750,000 is relevant to 10 months. So what was the per month cost? 75,000. Right. Now they are saying the project was completed on 30th April 20x5. Project completion on 30th April. The product produced by the project went on sale from 31st May 20x5. The project had been confirmed as feasible on 1st of January 20x5, and the product produced by the project was expected to have a useful life of 5 years. Now what happens here? 75,000, right? Now how much of that is going to be expensed? 75,000. Wait, now tell me, when did the project when did they decide the project was feasible? 1st of January, right? When did the project start? July, August, September, October, November, December. 6 months? Not. That's expense. Jan is when it was decided. So Jan, Feb, March, April. Jan, Feb, March, April. That's 4 months. So how much? 300,000, right? And this is the value that you're going to capitalize. What is the value you are going to write off? This, or we can even take 750, since we have 750,000 value, 750 minus 300. So this is what you are going to expense, right? But 300,000 you're capitalizing. Now tell me, when are you going to start the depreciation? When will you start the depreciation? Who should tell me? Hmm? Who tells? 1st January. Remember, capitalization cost you take when the feasible period, on that day you capitalize. But amortization or depreciation needs to start only once the asset is ready for use or sale. So when did it go for sale? On 31st of May 20x5. How many months? 1 month. 1 month depreciation. How many years is the useful life of the project? 5 years. This divided by 5. This into 1 over 12. 5. So this minus this. What's the carrying amount? 295,000. Option A. Clear? Is that clear? Right. Guys online, is that clear? Does that make sense? Quickly confirm. Right, okay. Then comes, so we're done with IAS 38. 21st question. Dempsey Co. owns a pharmaceutical business with a year end of 30th September 20x4. Dempsey Co. commenced the development stage of a new drug on 30th June 20x4, when the drug went into immediate production. The directors became confident of the project's success on 1st of March 20x4. The drug has an estimated lifespan of 5 years, and time apportionment is used by Dempsey where applicable. Again, IAS 38. Now tell me what happens here. How much are you going to, now here they are asking profit or loss for development cost. Now here you have to take the expense component, remember. So what are the components you'll take here? Expense component as well as amortization. These are the two elements that are going to impact, right? Now tell me, when are you going to capitalize this? The directors became confident only in March, right? When is the year end? March, April, May, June. Right. When did it complete? June, right? 4 months. 4 months worth cost will be capitalized. How much per month? 40,000. So what's the capitalization? 40,000 into 4 months. When did the commencement happen? Development new drug commenced on January, right? Jan, Feb, 2 months is going to be the expense, right? The expense is going to be 40,000 into 2 months. Right, now 160,000 is 4 months, 40,000 is the capitalization cost. But when do you start the amortization? How many months? So when did the drug go on sale? Complete on 30th June when the drug went into immediate production, meaning 1st July onwards. So July, August, September, 3 months is what we take. So how many years? How many years? 5 years. Out of this 5, we take 3 months related. So what's the total? 80 plus 8, 88,000. We have that option. 21 is D. Is that clear, guys? Clear? Right. All right. Then we move on to IAS 36. Okay, we can't see the options here, but let's read the question first, right? A division of an entity has the following balances in its financial statements. There is goodwill, there is plant, there is buildings, there is intangibles, and there is other net assets, right? Following a period of losses, the recoverable amount of the division is deemed to be 4 million. A recent valuation of the building showed that the building has a market value of 2.5 million. The other net assets are at their recoverable amounts. 2.3 million is what the CGU value is, right? The entity uses a cost model for valuing building and plant. Okay. Let's look at the question. Yeah. Question says, to the nearest thousand, what is the balance on building following the impairment review? What is going to be the building after impairment review? Do you allocate impairment to building? Will you allocate impairment to building? How much? How much will you allocate as impairment to building? Tell me. 2.5 divided by? They are saying the value of the building is 2.5 million, but actual cost of the building is 2.3 million. So actual value in the market is higher, right? When does impairment happen? When the recoverable amount is lower than the carrying amount. What's the recoverable amount? Higher of? Higher of? Fair value less cost to sell and value in use, right? So 2.5 million is the market value. 2.3 million is the cost. Do you think that building is impaired? Remember, IAS 36 says you first impair what is impaired. You let what is not impaired at the actual amount. Then you allocate, you remove the goodwill, then you allocate the rest. So building would remain. I mean, building there is no impairment. But is it going to be 2.3 million, 2.5 million? 2.3. Very good. Why? They're saying entity uses a cost model for valuing building and plant. Since it's cost model that they're using, the answer is going to be 2.3. A. Okay. Do you want me to do that working where the allocation works, or you all know how to do the allocation? You all can do the allocation? Right. Okay. The next question, 26, is the net assets of Feingle, a cash generating unit, are property, plant and equipment 200,000, allocated goodwill 50,000, product patent 20,000, net current assets at net realizable value 30,000, meaning you don't do any changes to net current assets, but the rest of it needs adjustment. As a result of adverse publicity, Feingle has a recoverable amount of only 200,000. Only 200,000. Now, out of 200,000 recoverable amount, 300,000 cost of CGU. What is the impairment? 300,000 minus 200,000, right? Carrying on minus recoverable amount. 100,000 is the impairment loss. Out of 100,000, you have to first allocate to goodwill. 50,000 goes there. What remains? 50,000 remains. Now 50,000, now 30,000, you're not going to do any adjustment there because that remains at 30,000 itself. 220,000 is what you are going to make this adjustment based on. Let's do the working here, right? Okay. PPE 200, goodwill 50, then the patent is going to be, patent is 20, then they have given net current assets, which is 30, right? Carrying amount, impairment, recoverable amount, right? Okay. Now, out of 200, 100,000, 50,000, you allocate to goodwill. So your goodwill becomes 0. That's what you do first. Here you do nothing because it's a near realizable value itself. So this remains 30,000. So what is that remains? 220, right? Now we do the allocation. How do you do the allocation? What's the remainder? 50,000. 50,000 into, first we are looking PPE. PPE allocation is going to be based on 200,000 divided by 220,000, right? So 50, right? Then let's say equals 200 divided by 220, 0.909. So you are allocating impairment this into, so what is the recoverable amount of the building? 154,545. We have that option A. Then what is the value going to be here? That's going to be this into this. Why is 0? Still I have not done the working. So how would the working be here? Yeah, we can do that also, but let's do it in the usual way itself, right? Let's do it in the correct way so that you don't forget at any point, right? Equals this plus this plus this. 200 recoverable amount matching, right? So if they asked you what would be the value of patent, 15.455. They are asking property, so it's going to be 154,545. Option A. Is that clear? How we all do the CGU allocation? First, you have to let the net realizable value based on market value is higher, not impaired asset, be at their value. Then you eliminate the value of the worthless assets. They'll say this was worthless, so you allocate that, you remove that. Then you remove the entire goodwill, then you allocate. Okay? Right. Yeah, let's do this last question. Then, we were not able to even cover 25. Why you're lazy? Why are you being lazy? Right, let's do this question first. Yeah. Relay acquired a non-current asset on 1st of October 20x9 at a cost of 100,000. Now, next class, if we do this, when are we going to do the past paper discussions? Let's see how I can, because I need to complete these 50 questions, MCQs, because that would help you all understand a lot of theories, okay? Relay acquired a non-current asset on 1st of October 20x9 at a cost of $100,000, which had a useful life of 10 years and a nil residual value. The asset had been correctly depreciated up to 30th September 20Y4. At that date, the asset was damaged and impairment review was performed. Indicator, right? Internal indicator. On 30th September 2020Y4, the fair value of the asset less cost to sell was 30,000, and the expected future cash flows were 8,500 per annum for the next 5 years. The current cost of capital is 10%, and a 5-year annuity of $1 per annum at 10% would have present value of 3.79. What amount would be charged to profit or loss for the impairment of the asset? Now here you are supposed to do the value in use calculation. Here you are supposed to do the net realizable value calculation. Then you are supposed to do the cost, the carrying amount calculation. Then you have to figure out what is higher of both to come at recoverable amount. Then you have to see what is lower of both and arrive at the impairment loss. Good questions, right? So this actually gives us insights into a lot. Yeah, that is all very much closer to exam questions, right? That's what I'm saying. For MCQs, Kaplan is the best material to practice, right? We have 420 MCQ questions, so that's like a lot of wealth of knowledge. Do it twice, 840 questions. So no one can, fail you, right? Even if they want to, they can't fail. Right. So now what happens here? First, we need to understand the cost, right? So what was the cost of the asset? Cost of the asset was, let's say, first carrying amount. So cost of the asset was how much? Cost of the asset was 100,000, right? Now, how many years was this depreciated? Hmm? How many years? X9, Y0, Y1, Y2, Y3. Entire Y3. So 5 years, right? So how much is that going to be? That 10 years is what they are saying, into 5 divided by 10. 50,000. So what is the cost? Carrying amount. So rather, this is the carrying amount. This is the accumulated depreciation, right? Okay. Then comes a recoverable amount. So what are two recoverable amounts given here? They have given two components. There is value in use and there is fair value less cost to sell. Fair value less cost to sell, they've given directly. They did not. Okay, so we'll look at how that works. Okay, the fair value less cost to sell, how much is that? 30,000. Value in use is going to be the present value of future usage. So that's going to be 8,500 into annuity factor. How much is that? 3.79. Right, value in use 32. So what's the higher of both? Higher of both is value in use 32,215. So what is the impairment? So this is the recoverable amount. The recoverable amount becomes this higher of both, right? Therefore, impairment is going to be 50, or let's make it in thousands, otherwise we'll have a problem. So 50,000. The impairment loss is this minus this. 17,785. That's what you are going to charge in your statement of profit or loss. Clear how value in use calculation works? IAS 36. How many questions did we do? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 questions. We should do more. A lot of things, no? So already we have absorbed. We have a lot to absorb yet, right? Okay. All right. So what I'll do is, fine. So today is third. How many classes do we have? 3, 10, 17, 24, and first is going to be only 3 mocks. So we have 4 classes. The next week, let's cover the MCQ. 17, 24, let's do the past paper and mock. That works? Yeah, because I want to practice more MCQs with you all so you understand things better. Okay, and don't be lazy. It's not time to be lazy. You all need to spare more and more time to learn. All right. Right.
So is it better to come here or online? Sunday classes.
I would recommend, yeah, whatever you benefit from again, but physical is where you have most of, yeah, interaction, question immediately, so all that. So there's more interaction. All right. So all the best, guys. Follow the 30-day planner. Shall I share the 30-day planner right now with you all? Yeah. So I'll just share the study plan. It's not in PDF, Shanuri. It is in Excel.
We can mark it.
Yeah, exactly. That's what I've done in Excel. So YouTube audience, I'm not sure how I can share study planner with you all, but I hope you all will be able to refer through the YouTube, I mean the videos, and just create, maybe open an Excel and just whatever you all saw on the screen, just imitate that and create an Excel file. So the live class students, I'll be sharing it on the group. Okay. So Azmat, I'll be giving out the mock marks by hopefully by Wednesday, because two of the guys have just half done it, so they are yet to complete and provide me. Once they provide, I'll be able to give you all the marks, because I'll be submitting the marks by Monday. By Wednesday, I should be able to provide to all of you. Right. So Umar, please share your answers by Monday. Okay. Don't be lazy. Shanuri, please share your answers by Monday.
Monday tomorrow.
Yeah, Monday's tomorrow. Is tomorrow you're starting the study plan. You won't have time. Okay, I need to submit the marks by end of the day tomorrow.
The reason I didn't do is face consultations too.
Go, I mean, today you have time on the way while you're going to your hometown. Just have a look at it. Right. All right, guys. So, all the best with the FR. Okay, fine. Can give you that allowance. Right. So, all the best. Prepare well. Look at all the elements that we discussed. Study harder and target to gain at least 75 marks. 50 marks is very basic. Anyone can do that. 50 marks is very easy, right? So target 75 marks and join the groups of extraordinary. All right. So I'll see you all on next Sunday. Until then, stay safe, take care, have a great week ahead.